If you have a couple of questions, you can ask me before class starts, so if anybody wants to. Go ahead, Michael. Good question?
How's the weather in San Diego?
It's always 70 and sunny, so it's the most predictable weather in the whole world.
On the case,
Yeah.
is it safe to assume that the incremental income to other divisions will not be attributed to this division in the accounting method?
Who cares, right? I mean, in a sense, that the only thing, I mean, ultimately keep your eyes on the price, which is you have to decide on the project. And unless you're going to base it on accounting returns, allocation decisions, attribution decisions, it's kind of irrelevant, right? So I wouldn't waste too much time because as an accountant, you can see you can go either direction. Ultimately, it's all about cash flow. So think about it, make a logical decision, but then say, look, it's not going to make my decision different. I'm going to move on to the cash flows. And I would say the same thing about things like depreciation. Don't overthink it. Don't have double declining, accelerated. I mean, it's really not worth the effort. So make the simplest assumptions on those and move on. Okay, I think we're almost at time. Let me go back to the page. Let's see how many people are on. So before I start, a couple of things. One is it's my unpleasant duty to remind you that a week from today you will have your second quiz, and it's going to be online. I'll send you the details. It's going to be available for about 9 hours next Monday. So I'll set the hours starting and ending because I know you're on different time zones. So I wanted to give you enough chance. Once you open the quiz, you'll have an hour to take it. It'll be a multiple choice quiz, but it'll look very much like past quizzes. So the only difference is instead of it being open-ended, I've worked out the solutions. There's only one right solution to every question, which is a bit of a disadvantage because if you make a math error, there's no way I can give you partial credit. That's why I've made it 5 smaller questions. So if you make a math error, all you can lose is 2 points. So that's going to be next Monday. I'll send you the review session, past quizzes, all the details after class today, so you're ready to go. In fact, it's already on the webcast page for the class. So that's the first thing. The second is your case is due before class on Wednesday because we're going to talk about it on Wednesday. So I want the cases kind of sent to me before then because after we've talked about it, it's kind of pointless. So before class on Wednesday. So really you have about 48 hours starting now to get the case done. And if it takes only a page or two to have the writing for the case, that's perfectly okay. The 4 to 5 pages is the absolute limit. I'm not talking about everybody's got to stretch. And what I'd like to see on the case, as I said in yesterday's email, is on the front page, if you can give me the 5 things I asked for: your cost of capital, the accounting return on capital, the net present value with the 10-year life, the net present value with the longer life, and your decision, accept or reject. No wishy-washy stuff, except maybe reject could be, it's got to be either you take the project or you don't take the project. And you give me a short justification, and it doesn't have to be entirely driven by your net present value calculation. You might decide that you could have a positive net present value and you're not going to take the project and give me a good reason why. Or you might have a negative net present value and you decide to take the project. Just tell me why. So that's what I'm looking for in the report. And if you can send me that Excel spreadsheet when you get a chance and as soon as you can, because what I'd like to do on Wednesday is while we're talking about the case, I'd like to show you what you found in the case, what your net present values were, what the accept rejects were. And the only way I can do that is if you send me the Excel spreadsheet by tomorrow, because I have to bring it into a summary sheet you know what I have to do. So that's pretty much the kind of administrative stuff. Before I move on, any questions related to either the case or the quiz you want to ask right now?
Professor, I have one question
Good.
regarding the course pack 2. You said it's going to be available in the bookstore.
No, forget the bookstore. The bookstore is kind of beyond redemption at this point. Just download the PDF file yourself. I mean, even the online bookstore, the bookstore always runs like 4 weeks behind schedule. They got the second packet 4 weeks ago. It doesn't look like they've made the copies yet. If you wait for them to make the copies, it's going to be almost impossible. I went on the online bookstore. There's no real way in which I can prod them anymore. So just download the PDF file and get that way. You don't have to pay the money either. So I'm sorry, but the bookstore is, I think, I'll write it off. There's no way they're going to do anything more this semester. Any other questions? Alexander says FedEx Online can bind it and ship it to you. So, I'll find the details on that. So if you really, really, really want somebody to bind it and have it in the form of a packet, I'm sure there's a way to do it. So I'll do some research on it. Because the NYU online bookstore is not going to be very receptive at this stage. Because I don't think there's anybody you can even talk to. And Staples too. So, if you can get the PDF file, there are lots of different ways you can get it done. So, no, that's for packet 2. We won't reach it till next week, so you have some time.
I had one question about the case.
Yeah. I can't, if it's an explicit question, I will be wishy-washy because it might not be the right forum to talk about an explicit question. But go ahead if it's kind of a general question.
Okay, it's an explicit question. Right?
Go. So why do you email me the question then? Because I don't think it's fair to your group or to the other groups to kind of throw something out there and then have people running around trying to say, oh my God, I never thought about that. No?
Right, I agree.
Okay. Okay, so any other questions? Okay. So let's go back to where we were. We were talking about using NPV and IRR, and we've looked at 2 projects so far. We looked at the Rio Disney theme park and the Vale iron ore mine. Today I want to switch gears and talk about something that's usually not thought about as a project, but to me are the biggest projects that companies take and often the biggest mistakes they make, which is an acquisition. I don't know what the reason is, but people never think of acquisitions as projects. But think about what you do in an acquisition. You pay a big amount up front to buy another company, right? That's like your initial investment. You get the cash flows from that other company in return, and you have to compute whether that investment is good or bad by looking at the net present value of the investment. So when you look at acquisitions, you really should be applying the same rules, probably even more carefully to an acquisition than you do to a small project. And the rules are that if you do an acquisition, it has to have a positive net present value. What does that mean? The present value of the cash flows from the acquisition have to exceed whatever you're paying up front. And it's true, that present value can include synergy, it can include control. All those magic buzzwords should be in the cash flows. You can do the analysis again from the perspective of just the equity or the entire firm, just like you can on a project. And when you look at the cash flows, the same rules that you use for a project apply when you do acquisitions. Remember when we talked about the discount rate you need to use for a project, we said it should be based on the risk of the project. For the Rio Disney theme park, we used the cost to capital for theme parks, not Disney as a company. The same rules apply in acquisitions. When I want to value a target company, it is the risk of the target company that should drive what discount rate I use, not the risk of the acquiring company. It's a simple capital budgeting rule, and it's a rule that gets violated all the time in M&A. So what I'm going to do is again create a hypothetical acquisition. And in this acquisition, here's what's going to happen. Tata Motors, which is an automobile company, is considering buying Harman Audio, which is a high-end audio company. It produces speakers, headphones. But Tata Motors is interested in acquiring Harman, not just for the fact that Harman is a well-established company in the audio business, but because they think they can use that audio know-how to improve the stereos in their cars. So there's a synergy benefit, and we'll set that to the side and come back and address it more directly. But I want to first value Harman from the perspective of Tata Motors and see if I can apply the same rules I applied when I do traditional capital budgeting. So let me start by laying out some of the details of this acquisition. First, in valuing Harman, I'm going to do my valuation in US dollars. Why? Because Harman is a US company, its financials are in dollars. It's going to be easier to do in US dollars. Could I do it in Indian rupees? Absolutely. I'm going to argue again, the answer is not going to be any different because currency should not make a good project into a bad project. So I'm going to do everything in US dollars. Initially, as I said, I'm going to focus on just valuing Harman as a standalone company, and then we can talk about the value of synergy separately. To get the beta for my valuation, I'm going to look at the unlevered beta of electronics companies in the US, and that unlevered beta 1.17 is what's going to become the basis for computing my cost of equity. Again, note, I'm not looking at automobile betas or Tata Motors beta. They're irrelevant because I'm valuing an audio company. For the equity risk premium, I look at the risk exposure of Harman Audio, not Tata Motors. And the breakdown for Harman Audio is they get about 27% of their revenues in the US, about 34% in Germany, about 19% in the rest of Europe, and about 19% in Asia. So I take a weighted average of the equity risk premiums of those regions to come up with an equity risk premium for Harman. Again, I'm focused on the target company, not on what Tata Motors revenue breakdown is. And finally, for the debt ratio and the cost of debt, I'm going to assume that Tata Motors is going to assume the existing debt of Harman and to preserve Harman's existing debt ratio. That's a choice. Tata Motors at the time of the acquisition could have decided to have a different debt ratio. I'm going to stay with Harman's debt ratio, and I've thought through that consciously. I want to make sure I don't over-lever on this acquisition, so I'm going to use Harman's existing debt ratio. Harman currently has a debt-to-cap ratio of only 7%, and it faces a pre-tax cost of debt of 4.75%. That 4.75% comes from looking at their actual rating, which was BBB minus. Again, remember, for the moment I'm acting like I'm valuing Harman Audio. Tata Motors is not even entering into the picture other than on that decision of what to do about the debt ratio. So here's what I'm going to do. I'm going to start with my unlevered beta, the electronics beta, and use the debt ratio that I'm going to leave Harman with after the acquisition, which is 7.98. This is the debt to equity. The debt to cap is 7.39. The debt to equity is about 8%. I come up with a levered beta 1.226. Then I use that levered beta 1.226 in conjunction with the risk-free rate in US dollars. Remember, I'm doing my entire analysis in dollars, and the equity risk premium for Harman Audio to come up with a cost of equity for Harman Audio of 10.26%. Finally, for the cost of capital, I use that cost of equity, 10.26%. I use the pre-tax cost of debt of 4.75%, but again, I look at Harman Audio's marginal tax rate, which is a US tax rate, which in 2013 was about 40%, to come up with a cost of capital of 9.67%. Again, what I want you to look at is the fact that I'm focusing entirely on Harman Audio. I'm not making any of the numbers come from Tata Motors because I'm valuing Harman Audio as a standalone company. So any questions up till there? Okay. So now let's talk about estimating the cash flows. To get the cash flows, I start with the operating income, which in the case of Harman Audio was about $201 million in the most recent year. But they did have some non-recurring expenses, and because these are truly non-recurring, as restructuring charges I add in the back saying, they're a one-time expense. They happened last year. They're not going to continue into the future. I did convert leases in debt because that rule doesn't change here. My adjusted pre-tax operating income for Harman Audio is about $313 million. Now in 2013, Harman paid only 18% of its income as taxes. Why so low relative to the marginal tax rate? Remember, Harman Audio gets a lot of its income outside the US. In Germany, where they don't have to pay as high a tax rate. So this reflects their effective tax rate. I'm going to use that effective tax rate to come up with the after-tax operating income. To get to cash flows, I need to know what their depreciation, capex, and working capital will be. And in 2013, I get those numbers. I get the depreciation of 120 million plus, capex of about 206 million, and then non-cash working capital, because it tends to jump around. I looked at what it was as a percentage of revenues. This is like a small scale valuation, but I'm essentially extending the same rules that I used when I computed the cash flow for a project to compute the cash flow for a company. So here's what I'm going to do. I'm going to assume that Harman Audio is a mature company. Why? Because it is a mature company. It's growing at about 2 or 3% a year. I'm going to assume it's going to grow at 2.75% a year. That's roughly equal to my risk-free rate. To get my cash flows for 2014, I always need cash flows next year. I grew the revenues and operating income out by 2.75%. So that's what you see as my expected revenues. Is revenues in the most recent year grown at 2.75%, operating income grown at 2.75%. I did assume they would continue to keep their taxes low, so the effective tax rate kicks in here. So even though I'm using the marginal tax rate for the cost of debt, I'm using the effective tax rate on this acquisition. My after-tax operating income is $263 million. I add depreciation. I subtract out capex. Again, I'm assuming those grow at 2.75% a year as well. And for the change in working capital, notice there's a big drop. You're saying, what happened? Remember I said I was going to switch to making working capital remain at 13.5% of revenues? So here's what I did. I took the change in revenues in 2014. So it's a roughly $120 million change in revenues. And if you multiply the change in revenues by 13%, I get working capital change in the next year. This is the most sensible way to get change in non-cash working capitals rather than take last year's change, which God only knows what that number will be, is to take change in revenues and apply the change in working capital. So you get a cash flow next year of $167 million. That is going to be my expected cash flow next year. I'm almost set to go. Because this is a mature company, I can take those cash flows, $166.85 million, because it's growing at 2.75% a year in perpetuity. I can use that growing perpetuity equation. So I've got my expected cash flows in 2014, my cost of capital, which I computed a couple of pages ago, my growth rate of 2.75% forever. I get a value for the operating assets of $2.5 billion. Now, when Tata Motors buys Harman, it's also going to get the cash that Harman has, $515 million. And I did say they were going to assume the existing debt of $313 million. My value of equity in Harman is $2,476 million plus the cash minus the debt. I get a value for the equity of $2,678 million. Now remember, Tata Motors is thinking about buying Harman, right? The value of equity that I'm getting, valuing Harman based on its cash flows, is $2,678 million. The market cap for Harman was $5,428 million. If at this stage I asked you, should I buy Harman? Your answer is going to be, are you crazy? Why would I do that? My net present value is minus $2,750 million. Now, that is absolutely true. If I stop there, I have minus $2,750 million. There is some synergy here, which we haven't valued. We're going to come back and talk about valuing synergy separately and what rules might apply to valuing synergy. But this is always the first step in an acquisition before we even talk about synergy. You first need to value the target firm. And I call this a status quo valuation. Look at the market cap and say, how much of a gap is there for me to try to make up with synergy? In this case, I need my synergy to be worth at least $2,750 million for this deal to even get it over the hump. So when you do acquisitions, it's just an extended capital budgeting. So if you can so the good news here is when you look at the case, if you can take the present value of the cash flows and value Netflix fit, you can value a company. There's really no difference. In fact, I could have made the case Netflix is thinking about buying Peloton. And you'd have done exactly what you did in the case to value Peloton. So you're actually ready to value a company if you can do the case, because the tools you use there are exactly the tools. No. Now, Perry says, assume they don't have to pay a premium. They do have to pay a premium over the $5,428 million, which makes it even more difficult to get your value. So you're right. Even the $2,750 million that I've come up with is a lowball number, because if they go to try to buy Harman, they're not going to be able to buy it at the market cap. They'll have to pay a premium on top of the market cap. Now do you see why creating value from acquisitions becomes such a steep climb? You start with the market price and you build up. Getting a positive net present value is really, really difficult to do. And that's why earlier in the class we talked about how most acquisitions fail, especially acquisitions of public companies, and this is one of the reasons. So I know I threw a lot at you in those 4 pages, so I'm going to take a pause and let it absorb it. If you have questions, I want you to kind of throw them at me. Because these can be questions about anything in capital budgeting, because an acquisition is just a really big capital budgeting project. The question from Sarah was how I came up with the 2.75%. The 2.75% first in the cost of equity and capital is just the T-bond rate, it's the risk-free rate. I assumed a growth rate roughly equal to that risk-free rate. So the growth rate for the future is always an assumed number. So in this case, I assumed 2.75%. I could have assumed 2.5 or 2.25%, but growth in the future is always an assumption. Any other questions? Okay, so now I'm going to move on to the next phase. Okay, now Rizwan's question is, why does the market value of equity deviate from the actual value of equity? What do you mean actual value of equity? This is, are you saying the 2,678 million is the actual value of equity? That is my estimate of the value of the equity. Nobody knows what the actual value of equity is. You have your value, I have my value, there's a market value. One of us is going to be more wrong than the rest, but we're all trying to estimate that's something nobody knows. So even if you were godlike and you estimated the value of equity precisely, the market can make mistakes. So the market value of equity doesn't have to be equal to whatever the correct value of equity is. Now Shashanka asked, can you assume that the cost of debt can be Tata's cost of debt? Don't do it. And here's why. Let's say Tata's cost of debt, because remember I used Harman's cost of debt. And Shashanka is raising a good question, which is, what if Tata's cost of debt is lower? Couldn't they replace the more expensive debt with cheaper debt? They could. But do you want to build that into your cost of capital, lower your cost of capital and pay a higher price for Harman? Because if you do that, think of what you've done. You rewarded Harman or your stockholders for something that they had no role in creating, which is you're a nice, safe company. There's a simple rule in acquisitions. Render unto the target company that which is theirs, but not a cent more. So if you're a safe company, don't put your low cost of debt into the cost of capital and push up what you pay, because it's not right. Okay? Emily asked, in real M&A cases, will this be more depending on the valuation? Don't. First, investment banking and accounting firms don't value companies. They price companies. And why do they price companies? What do they want to do? Emily, why don't you come on? Unmute yourself if you can.
What do they do?
Yeah. How, if you work at an investment bank at M&A, how do you make money?
They charge transaction fees.
They have to get a deal done. How do you get a deal done?
Match the price.
No, you got to pay more than 5,428 million, enough that you can get the deal done. So your motive as an investment bank is to get the deal done. Is there anything in that motive that requires the net present value to be positive or the acquiring company to make money? Emily?
Sorry, what was the question?
The question is there anything in your motive as an investment banker that requires that the acquiring company actually get value from the acquisition?
Yeah, they will try to put the price requested by target company as low as possible.
No, absolutely not. Their objective is to get the deal done. What do they care about the acquiring company? You know what I'm trying to say is, you walk into an electronics store and you ask the salesperson, what's the best TV for me? What are you going to always work out with? You're going to work out with the biggest, most expensive TV there, because he gets the biggest commission. Asking an investment banker, in this case, whether what to pay for a deal is stupid. I don't know why acquiring companies do it other than to pass the buck. It is your stockholders' money. You've got to do the homework. So whatever happens in real M&A, the only reason it happens is because everybody wants the deal done. So you want to do it right? You as the acquiring company have to do your own homework. So if I were advising Tata Motors, I said, don't trust Goldman Sachs. Don't trust Ernst & Young to do this for you, because it's not their money. It's other people's money for them. It's your job to do this. And Nothing that is there any special skill that you needed to value? There's nothing here that is rocket science. So why can't acquiring companies do this themselves other than to pass the buck? Now, Alison, you asked why I use the marginal tax rate for the cost of debt and effective tax rate for after-tax operating income. So basically, I use two tax rates. I use the 40% to come up with the after-tax cost of debt. But if you go back to the previous page, I use the effective tax. I use the marginal tax rate to get the cost of debt, 40%. But I use the effective tax rate to get the after-tax operating income. Okay, so the rationale is interest saves me tax at the margin. So I'm going to find a way to get my 40% tax benefit, but my cash flows, I can use tax deferral. I can be clever. So I'm assuming that the company will continue to be clever.
The professors.
Yes.
By just talking about investment banks' incentives, does the company or the bank advising Harman have an incentive to put a lower price to get the deal done?
Let's face it, if you have four people in that, is it a friendly merger? Let's say it's a friendly merger, which most mergers are. There are four people in that room, right? There's the target company's managers, there's the acquiring company's managers, there's the target company bankers, the acquiring company bankers. So let me ask you a question. Is there anybody in that room who doesn't want the deal to get done? Because remember, the target managers are being co-opted. They want the deal to get done. The acquiring company managers want to get the deal done. The target company the bankers on both sides want to get the deal done. There will not be a single dissenting voice there as they keep hiking up the numbers to make the deal justified. Hostile acquisitions, it's more interesting because there you can get a pushback from the target company because the target company doesn't want the deal done. But in friendly mergers, it's not the manager's money, they're spending stockholders' money. So unfortunately, there is nobody there who's asking the tough questions. No. So unfortunately, you're kind of stuck with the bad advice because you're getting advice from a really biased source.
Just had a quick question regarding the effective versus marginal tax rates. My understanding was that we should always be using marginal tax rates for converting earnings to cash flows because
on projects. Remember, on projects that's true because you're adding a project on at the margin. So but when you're talking about acquiring a company in a different country with a different set of tax laws, that's why with acquisitions and valuations you can relax that rule. But for individual projects that companies stay, I would stick with the marginal tax rate.
All right, thanks.
Yeah. Any other questions? Now we'll talk. I know that this is a very quick run through acquisitions. I do a session on acquisitions called Acquirers Anonymous: 7 Steps to Sobriety, because I think companies get addicted to acquisitions, and bankers act like drug dealers, feeding the addiction, and consultants do the same. So in my view, more value is destroyed through acquisitions than any other single corporate actions. I'm a cynic when it comes to acquisitions. So I think that we'll get a chance to revisit this, if not in detail in this class, when you take the valuation class, which I promise you, we'll spend lots of time on this separately. Okay? But we'll come back and talk about synergy in this deal because that still is an X factor here. Any other questions before we move on to the next section?
Yeah. So just continuing with Shashanka's question, if just by being a part of Tata Group, if Harman is able to get like a cheaper debt, would you yet not consider that?
Not when I pay for the company, because think of why it's getting the lower cost of debt. It's because Tata Motors has worked hard to be a nice, safe company. If I build that into my cost of capital and push up my value and justify an acquisition, think of what I've just done, right? I've paid that premium because it's going to make my value higher if I use the lower cost of debt. If I then pay that higher value to Harman to acquire the company, I would have then paid the premium to Harman Company shareholders for something that they had no role in creating. So I'm not saying after the acquisition, Tata Motors is not going to benefit. But I'm going to argue that that benefit belongs to Tata Company shareholders, not to Harman shareholders. It might sound like, it doesn't matter that much. Who cares? But the reason we care is if you pay that as a premium, Tata shareholders don't have it. Okay, so let's move on to the next section. I mean, when we looked at the Disney theme park, it was a standalone investment. What do I mean by that? You invest, you get cash flows, your net present value is zero, or it's greater than zero, you accept the project. If it's less than zero, you reject the project. Same thing with the Vale Iron Ore Mine. You do the cash flows, the net present value is greater than zero, you accept. If it's less than zero, you reject. Same thing with the acquisition. You either do the acquisition or you don't. But in most cases, when companies take projects, these projects are not standalone. They create side effects for the company. Sometimes by taking a project, you can't take other projects. That's called mutually exclusive projects. In other cases, when you take a project, it creates side costs and side benefits. In fact, even in the Rio Disney, you could argue that there are going to be side costs and side benefits to Disney as a company. I mean, Disney, everything is connected to everything else, right? When they when they put out an animated movie, it's not just the movie business that benefits, the theme parks benefit as well. So in this section, what I'd like to talk about are those side costs and side benefits. And one of the side benefits I'm going to talk about in the acquisition is synergy, because that's potentially a side benefit. So let's first talk about mutually exclusive investments. What are mutually exclusive investments? You get to pick. If you pick, so there's A and B. If you pick A, you can't pick B. And if you pick B, you can't pick A. You say, when would that be the case? Let me give you a very simplistic example. Let's suppose you own a house and you're deciding to put a new heater into the house. And you can either go with a gas heater or an electric heater, but if you pick one, you can't pick the other. You're not going to put both heaters. So when you do your analysis, you're going to say, which heater is better for me? And you're going to pick the better one. When you look at a company and you're trying to decide, should I invest in so let's say you have a potential, two ways of entering a new market. You can go small scale or big scale. Two choices, they're mutually exclusive. So when they're mutually exclusive, the question becomes, how do I decide which investment is better? And if I can make the decision, which decision rule gives me the best choices? So let's look at the simplest version of mutually exclusive investments. If you're looking at two investments with the same life, you know what I mean with the same life, two 10-year projects, two 15-year projects, the choice becomes a relatively simple one. You can take all of the decision rules you had with individual projects and extrapolate them to mutually exclusive projects. What does that mean? You have two 10-year projects. If your particular decision rule is accounting return on capital, which I don't like, but maybe that's your rule, you can pick the project with a higher return on capital. If net present value is your preference, you can take the two projects, two 10-year projects, and pick the one with a higher net present value. If internal rate of return is your preference, then you can pick the project with a higher IRR. In fact, many companies, when they do mutually exclusive projects, just do the IRR or NPV of all of them and pick the one with the highest NPV or the highest IRR. We'll talk about even in this scenario, sometimes you can get different rankings. And that's what I'm going to focus on for the next few minutes. Is you're comparing two projects, they have the same life, you're doing NPV and you do IRR, and you get different rankings, different choices. I want to look at why that might happen. Let's take the simple example first. Let's assume I give you two projects. They're both 4-year projects. Project 1, you invest $1 million up front, you get $800,000 in year 1, $1 million in year 2, $1.3 million in year 3, and then you have a minus 2.2 million in year 4. You say, when would that be the case? Let's say you have a license fee that has a tail end fee. At the end of the project, you have to pay 2.2 million. So this project has a negative cash flow right now and a negative cash flow in year 4. On project 2, I have a negative cash flow, minus $1 million in year 1. Then I have a more conventional set of cash flows. 200 million in year 1, 300 million in year 2, 400 million in year 3, 500 million in year 4. What I'm going to do with these two projects is I'm going to compute the net present value first of these two projects. And then I'm going to compute the IRR. So if I do the net present value in the IRR, here's what I get. When I do IRR, remember I do a net present value profile. And remember the rule, the IRR is that point at which your net present value is positive. So on project B, I get a pretty conventional looking net present value profile. The IRR is about 11%. But on project A, I get two internal rates of return. two places where the net present value is 0. The net present value can either be about 4 or 5%, or it can be as high as 35%. So when I do my net present values, I always get unique net present values, and I can decide which project is better. But when I do internal rate of return, I get two internal rates of return for the first project, 6.6 and 37%. And on project 2, I get one internal rate of return. So I have two questions, and I'm going to throw it out, and I'm going to pause and let you try to answer. Why are there two internal rates of return on project 1? So let me go back and show you the two projects. What is it about project 1 that gives you two internal rates of return? Anybody?
Is it because the cash flow sign changes twice?
Exactly. In fact, we don't think of it in this way, but an internal rate of return is a root to an equation. That's what it is. We don't ever think of it because we use the IRR function or the profile to solve for it, but it's a root to an equation. When you have only one cash flow sign change, which is what we tend to think of in conventional projects, big upfront initial investment, positive cash flows thereafter, there's only one internal rate of return. But every time you have a sign change in your cash flows, you have another root to the equation. I know this is deep math, but in a sense, because you have two sign changes, you have two internal rates of return. You're saying, when would I ever have that? No, I don't know whether this is happening in your Netflix Fit case, but often when you have a really long-term project, sometime in year 7 or 8, you might have to make an additional investment in whatever, a new plant, a new equipment. And that year 7 or 8, you can get a negative cash flow. So this is not uncommon. In fact, in many 30-year projects, you can have 3 or 4 sign changes, which means you can have 3 or 4 internal rates of return. Do you remember what the rule was with IRR? You accept a project if the IRR is greater than the cost of capital, right? So let's take project 1. Let's say your cost of capital is 12%. Would you accept the project or reject it? Is there a way I can answer that? I'm sorry, I couldn't hear you.
I'd like to give this a shot. I think it depends if you think you have the ability to reinvest at 36%.
Do I even have to go that deep? Can I look at the net present value profile and answer the question? Remember I said NPV is always unique? At a 12% cost of capital, my net present value in project 1 is positive. My net present value in project 2 is negative. So you know what the rule is when you have more than one internal rate of return? Use NPV. I know it sounds simplistic, but I've seen people do all kinds of contortions with multiple internal rates of return. It's such an incredible waste of time. When you get multiple internal rates of return, the net present value rule will always deliver an answer. So in this case, I'm going to pick project 1, even though I have all this noise from the IRR. Why? Because on project 1, the net present value at a 12% cost of capital is positive, and that's all that matters to me. That is my hurdle rate, and I'm going to accept project 1. So bottom line, multiple internal rates of return can happen. Don't freak out. If they do happen, just go back to NPV. You're always going to be okay. Any questions on multiple internal rates of return?
Professor, I had a quick question.
Go ahead.
I'm slightly confused about why I should pick a project with a high IRR, because if the IRR is low on a project, it means that as the return...
No, I didn't say... I said if all you have is IRR, then you pick the one with the higher IRR, right? Because they're mutually exclusive. But you're saying they're both lower than the cost of capital. Is that the question you're asking?
No, the question is why should I pick one with a higher IRR? Because the higher IRR implies that the return has to be more on that project for me to generate profit.
No. You're misreading IRR. IRR is what you make on the project. What you need to make is to remain your cost of capital. So just because you have a higher IRR doesn't mean you need to make more on the project. It means you're making more on the project. What you need to make is your hurdle rate. Do you see what I'm saying?
Got it.
Okay. Now let's take the second case. Here I'm going to give you two projects. They're both 4-year projects, and I've kind of given you the numbers. First project is a smaller project. It's got $1 million upfront initial investment. It's got positive cash flows for the next 4 years. Its net present value is about $468,000. The IRR is about 34%. Project B is 10 times larger, $10 million upfront initial investment, much larger positive cash flows. The NPV on Project B is $1.36 million and the IRR is 21%. Remember, they're mutually exclusive. You can take only one of these two projects. So I have a question. Which of these two projects would you take? Would you go with the NPV and pick Project B, or do you go with the IRR and pick Project A? Anybody? I want somebody who's going to pick Project A to be the first one, because I think there's actually a good case you can make for both, and I want to put you on the spot depending on whichever one you pick. So who would use the IRR rule to pick a project because you get a bigger bang for your buck?
I would pick the Project A.
Okay, who's this?
Darshan.
Okay, Darshan, so you pick Project A. I'm going to put you, and so your rationale is?
Yes, I mean, assuming I have more access to such projects, I would
Exactly. In fact, you've answered that question. So if you pick Project A, your biggest worry is what?
if I find some similar projects or not.
Your biggest worry is you don't find those similar projects, right? So if you pick that first project, let's say you pick it on January 5th, saying they're going to be good projects that come for the rest of the year. And let's say it was 2020. You know what you're doing now? You're beating yourself up saying, I shouldn't have done that. My projects have all dried up. So if you pick Project A, your biggest worry is that you won't have enough projects to invest your remaining $9 million in, right?
Yeah.
Okay. Who would pick Project B? Because every corporate finance textbook always says pick the project with a higher net present value. Let's see what the implicit assumptions are and what the danger of doing that is. Anybody who picked Project B? Who would pick Project B? Nobody? So I'll play the role. I'll pick Project B. Why? Because I've been taught in every finance textbook. Yeah, somebody go ahead.
I would probably pick Project B if I had a lot of capital.
And in fact, you've answered my question too. If you pick Project B with 10 million, your worry is that if other projects come along, you might not be, let's say great projects come along in the future, that you wouldn't be able to take them. So when you pick Project B, you're implicitly assuming that you have access to capital. Am I fair in saying that?
Yeah, that's that.
So if you're a Microsoft, if you're a Google, you're an Apple, of course you should go with NPV. Do you see what I'm saying? Why? Because you're not worried about raising more capital. You have enough cash on the books to take every project that comes along from now through eternity. So the answer to NPV versus IRR is not the slam dunk you see in most textbooks. In most textbooks, which I was told, always take positive net present value projects. NPV dominates IRR. Implicit in that statement is the assumption that we live in a world where we have infinite access to capital, and we know that's not true. If you're a smaller company, if you're a company in an emerging market, if you're a private business, or forget about all of that, if you're in the coronavirus environment, you could be any company with limited access to capital. My advice to you is go with internal rate of return. The textbooks might not back you up, but you got to get the biggest bang for your buck. If on the other hand, you have lots of capital, you have huge amounts of cash, then go with NPV because it gives you the biggest value added as you take projects. So whether you take NPV or IRR boils down to, do you face capital rationing? And there are actually studies that look at capital rationing, and they conclude, not surprisingly, that most companies face capital rationing, even big ones. But the interesting thing is, in most companies, the capital rationing, especially if you're bigger companies, doesn't come from outside. You know what I mean by outside? Some companies, the capital rationing comes from the fact that you can't go to markets, banks won't lend to you. It's an external constraint. In many larger companies, the constraint is internal, where the company faces a constraint on capital because it can't issue equity or will not issue equity. What's the most common reason publicly traded companies don't want to issue more equity? It's in fact this is like a buzzword that every banker uses for why you shouldn't issue more equity. What's the word?
Control.
Now, dilution. Dilution is a bogeyman, right? Because when you issue new equity, you have new shares. When you have new shares, supposedly it's bad for you. Horrifically stupid advice. Because when you issue new shares, you take that capital, you do a really good project. Guess what you've done? You've increased the value of your firm more than proportionately. But a lot of companies, because they will not issue new shares, face capital rationing constraints. So for better or worse, when you have a capital rationing constraint, you're going to see yourself focus on IRR. If any of you worked at private equity firms, their favorite device for picking across investments is not NPV, it's IRR. They want to go where they get the biggest bang for their buck because they view themselves as capital constrained for whatever reason. Sometimes it's real, sometimes it's self-imposed. So capital rationing is real and we can't make it go away or wish it away. It is there. Okay? One final point about capital rationing, and I'll open the floor again. Now, we'll talk about one of the problems with the IRR is with the reinvestment, and I'll talk about this with the next project and with the next example we do. But let's say you face a capital rationing constraint. I said go with IRR. Let's say you don't like IRR. You don't like the assumptions that IRR makes. There's a way in which you can convert NPV into a scale measure. Because think of what's happening. The reason your NPV is higher on project 2 in the previous example than project 1 was project 2 was bigger, the upfront initial investment. What if you took the NPV you get on a project and divided by the initial investment? So if I took my previous example, I take the net present value of project A, 468,000, divide by the initial investment of $1 million, I get 46.79%. That's called a profitability index. It's a scaled NPV. And that 46.79% is much higher than my profitability index for project B, which is 13.59%. Because the investment is so much bigger, I pick the project with a higher PI. It allows me to stay with NPV and take into account the fact that I have a capital rationing constraint. Again, I want to pause and allow that people to absorb that. Are there any questions on the capital rationing constraint and why you might use NPV or IRR?
Professor, I have a question on the first case where there were two IRRs.
Yeah.
I think you said take project A if the NPV is positive.
No, I didn't say project, because when you do mutually exclusive, it's not the NPV being positive.
It's not this one.
This one. I said because it has a higher, so if you look at it at 12%, right?
Yeah.
The net present value of project 1 is positive. The net present value of project 2 is negative.
Oh, I see. Okay.
Right?
Because the IRR for project 2 is lower than 12.
Forget about the IRR. This actually, if you drop from the 12%, which is the discount rate, that's the actual dollar NPV. That's about 50 million for project 1. It's about minus 30 million for project 2. So you don't even have to use an IRR anymore. You're just going with NPV. Would you pick plus 50 or minus 30? I would pick the plus 50 every single time.
Yeah.
Okay. Any other questions? Now let me ask you a question. Do you think this crisis is going to create more capital rationing constraints around the globe?
Yes.
Absolutely. I'm sorry? Yeah, all over it's going to be, it's not just going to be emerging markets. Every company is going to face a tighter constraint. In fact, if you borrowed a lot of money in the past, your constraints just got a lot tighter than they used to be, right? An airline, you can't even think about expanding. What you'd be crazy to. That's what's killing Boeing. Boeing's valuation is not just that they're in trouble, but that their customers all have taken their buying plans off the table. There is no chance that United is buying 35 more aircraft like they were planning to. Maybe they might buy 6 as replacement. But capital rationing constraints are kicking in. IRR is going to become a much more commonly used approach to picking projects than it was before the crisis. This is almost like a shifting decision rule. That's why I don't like it when people categorically say, well, NPV is the best rule, right? Well, it depends. It depends on who you are as a company and where you are in time. And I think it's well worth thinking about that capital rationing constraint when you think about what decision rule should I use, especially when you're picking between projects. Okay, let's look at a third example. And I think, some of you have already sensed what the reason for this difference is going to be, but let's dig in a little deeper. I'm going to show you two projects again. And both are projects with the same life, 4 years. Both projects have an upfront initial investment that's exactly the same. So you don't have the problem you had in the previous case of different scales. So both projects are $10 million projects. I give you the cash flows. I compute the NPV and IRR in both projects, and here's a puzzling thing. They both are projects of the same scale. NPV and IRR are both time-weighted cash flow returns, so they both come from the same source. But the NPV of project 2 is greater than project B is greater than the NPV of project A, but the IRR gives you the reverse. So here's my question. They're both time-weighted incremental cash flow returns. These are both 4-year projects. They're both $10 million projects. Why do they give you different rankings? There must be something I'm doing within each approach that's different, that's leading me to different end games. So what is it that I'm doing in each approach that's leading me to different conclusions?
You do more cash up front.
No, I don't do much. It's the same initial you're saying I get more cash flows up front, but they're both time weighted, right? So they should both be weighing that fact that I get more cash up front.
The return you're assuming on the reinvestment.
Okay. Let's be more explicit. Who's that? Is that Perry? Perry, go ahead. When you say reinvestment, what exactly are you talking about?
So in project A, let us pick that up. If you are doing an IRR calculation, you are assuming that the 5 million you get in the end of the first year, you're going to be reinvesting it at the IRR.
At the IRR. With the NPV, what am I assuming about the 5 million?
That you're going to reinvest it at the cost of capital.
Exactly. So let me flesh. Perry's absolutely right. Let me flesh out what Perry just said. I have 4-year projects, right? But in each project, I get cash flows in year 1, year 2, year 3, and then year 4. The cash flow I get in year 1 doesn't disappear into thin air, right? It gets reinvested somewhere. And in the NPV approach, I'm assuming I can reinvest at the cost of capital. And the IRR approach, I'm assuming I can reinvest at the IRR. So in this case, in project A, that 5 million, if I have an IRR of 21.41%, I'm assuming that I can find other projects out there that can make 21.41%. Whereas with the NPV approach, I'm assuming I can find other projects that make a 12% cost of capital. That's my cost of capital. So the NPV approach, reinvestment happens at the cost of capital. The IRR approach, reinvestment happens at the IRR. Which one's the more dangerous assumption? To reinvest at the cost of capital or to reinvest at the IRR? Think of why, right? I see a lot of IRRs, and here's why. Let's suppose I am a private equity guy and I come to you and say, look, I have this great project. It's a 10-year project. And I tell you the internal rate of return is 50%. Impressive, right? But before you get too impressed, remember that 50% IRR assumes that not only will I make 50% on this project, I have a bunch of other projects which I have where I can go year 1, year 2, year 3, year 4 and make 50% on those projects as well. That's a really dangerous assumption. The IRR's assumption that you can reinvest at the internal rate of return can create a lot of problems on high IRR projects. So that's why people often say, well, NPV is a better rule technically than the IRR because it makes a safer assumption. Why is the cost of capital a safer assumption? Because it's what I can make on similar investments elsewhere. That's where I got the cost of capital. I looked at what other companies of similar risk could generate as a rate of return. So almost by definition, there are other investments out there that generate the cost of capital. Whereas with the IRR, I'm asking for the moon when I have high IRR projects. So the NPV rule, the intermediate cash flows get discounted back, get reinvested at the hurdle rate. The IRR rule, the intermediate cash flows get reinvested at the IRR. And when the IRR is really high, the IRR rule will probably overstate the actual returns you will make on projects. Are there any questions on that? Because I know it's kind of a hidden assumption because you don't even think about it, but it is an assumption nevertheless that drives your decision. and as a consequence, high internal rates of return, you shouldn't throw them away. I'm not saying it's bad. I'm just saying you should look at it a little skeptically, because your true internal rate of return on that project will probably be lower because you will not be able to generate that IRR on intermediate projects. What do you consider as high for any number higher than the cost of capital? It's a relative number, right? So the closer you get to the cost of capital, the less dangerous the assumption became. So now I'm talking about high, just look at it relative to the cost of capital. Now there's a fix for the IRR assumption. This is called the modified internal rate of return. So let me explain how this is going to work. The big problem with the IRR approach is what you're assuming will be the reinvestment rate on the intermediate cash flows, right? So let's take a very simple project. It's a 4-year project with a 15% cost of capital. So I have my initial investment of $1,300,000 in year 1, $400,000 in year 2, $500,000 in year 3, $600,000 in year 4. If I do just a standard internal rate of return, I get an internal rate of return of 24.89%. But remember what that assumes. It assumes I can reinvest the $300,000 at 24.89% for 3 years, the $400,000 at 24.89% for 2 years, and the $500,000 at 24.89% for 1 year. And I said, I don't like that assumption. I said, I'd much rather prefer the NPV rules assumption of reinvesting at the hurdle rate. My hurdle rate here is 15%, right? What if I took the $300,000 and invested at 15% for 3 years? That's going to give me $456,000 at the end of year 4. I take the $400,000 invested back at 15% for 2 years. I get $529 in year 4. I take the $500,000 reinvested at 15% for 1 year. I get $575,000 at the end of the 4th year. If I add up all of the cash flows I now have at the end of the 4th year, I get an ending value of $2160. So here's what I have in my investment. I have an initial investment of $1,000. My intermediate cash flows are all reinvested. I have an ending value of $2160. If I just take the starting and the ending numbers and compute the IRR from that, that's called my modified internal rate of return, 21.23%. That modified internal rate of return uses the same assumptions as the NPV rule. I don't like the convolutions you go through to get a modified internal rate of return, but a lot of people prefer internal rates of return over NPV. And if you're really stuck on IRR and you don't like the reinvestment assumption, here, you can use the modified internal rate of return. You get some of the good stuff from NPV and you can stay with your internal rate of return approach. So that was what I was going to say about NPV versus IRR. Any final questions about the approaches before we move on? Because we've kind of covered the spectrum, right? Accounting returns, we've looked at NPV, IRR, modified IRR, profitability index. We've looked at a spectrum of approaches. Our end game is we want to make sure we pick projects that actually increase our value as a company.
Sorry, Professor, did you say with this approach, the analysis with both IRR or modified IRR and NPV should get the same answer?
Exactly. So if you go back and apply this approach on the third example we did, you'll see them converge in terms of giving you the same ranking.
Okay.
Try it out if you want. That's actually a good way to make sure you get this is go to the example 3 that we did and see. Ben's asking where's the 1.15 coming from? That's just the 500,000 invested at 15%. 15% was your cost of capital. So basically that's the third year's cash flow invested for 1 year. So 1.15 is 1 plus the cost of capital. No other questions? Okay.
So I still don't see what's the mathematical difference between NPV and modified IRR. It seems very similar.
No, in the IRR, here's what you're assuming. You're investing, instead of 15%, you're investing at 24.89%. You're acting like you're going to be able to take the 300,000 and invest it in another project that makes 24.89%.
Oh, that I understand. I just wasn't sure what's the difference between modified IRR and the NPV.
Oh, there's no one. Once you have modified IRR and NPV, you are going to get the same, but you still have the scaling issue, right? Which is small projects are always going to look better on a percentage basis, and large projects are still going to be. So the capital rationing thing, you still have the same issues. So modified IRR and NPV have the same reinvestment rate assumptions, but you'd still get different rankings if you're comparing small to big projects.
Got it.
Yeah. So here's the bottom line. Now, when you're looking at a project can have only one NPV. That's always true. It's unique. IRRs, you can have more than one when you have sign changes. IRR is going to bias you towards smaller projects. NPV is going to bias you towards bigger projects. Which one's better depends on whether you have a capital rationing constraint. NPV assumes intermediate cash flows get reinvested at your hurdle rate, your cost of equity, your cost of capital. IRR assumes you can reinvest them at the internal rate of return. The IRR assumption is less defensible, more dangerous. So that in a nutshell is a summary of the difference, but I think we make too much of the differences. When I took my corporate finance class, we spent 3 entire sessions on NPV versus IRR, which I thought was a huge waste of time. Because when you have a standalone project like Netflix Fit, it really doesn't matter whether you use NPV or IRR, they're going to give you the same decision. It's only when you choose between projects that it becomes an issue, and even there, 9 times out of 10, you're going to get the same decision with the 2 rules. So my view is, I want you to use time-weighted incremental cash flow returns, and if you want to use a percentage return and you want to use internal rate of return, I'm going to let you use it because you're 90% of the way towards where I want you to be, and that's okay for me. Okay. So if there are no questions on NPV versus IRR, I'm going to take a slightly different example for mutually exclusive projects. In the 3 examples we used, the projects we were comparing had the same life. So I could compare NPV or IRR. But now I'm going to compare 2 projects with different lives. So here I have the first project is a 5-year project. The second project is a 10-year project. The projects are of slightly different scale. On project A, though, I get $400,000 for the next 5 years. On project B, I get $350,000 for the next 10 years. So I'm going to do NPV and IRR for the 2 projects. And I'm going to make you pick between the 2 projects, and you tell me whether the fact that they have different lives might come into play. So I do the NPV of project A, I get 442 million. I get the NPV of project B, I get 478 million. I do the internal rates of return. Project A has a much higher internal rate of return than project B. So the cost of capital is 12% for both projects. They're both good projects, but they're mutually exclusive. If you pick one, you can't pick the other. Which one would you pick? Okay. So Rizwana, when you said you pick project A, you're overriding the NPV rule. Why?
Well, firstly, because the second project has a longer time horizon, so it's riskier.
So I have more cash flow, so it's almost unfair, right? If I compare a shorter life project to longer life project, the longer life project, even if it's not as good, is not going. It's not fair to the first project because it's shorter. Is there a simple way you could fix this? Let's say you want to stay with the NPV rule because you don't like the IRR and the reinvestment rate assumptions. Is there a way I could make these 2 comparable? Rakshan says payback, but then I'm abandoning time weighting and cash flows. I'd like to stay with the time weighted approaches.
PEI, the profitability index.
I could do PIs, but even there I'm going to come up with, that's not going to fix my basic problem though. I get a lot of what if I could do project A twice? I know it's incredibly simplistic. Wouldn't it make my problem go away? What if I could replicate project A? If I did that, then 2 times project A would be 10 years. And in fact, that's the first solution, is to replicate the 2 projects till they have the same life. In this case, it was very easy. 5 to 10 is basically do twice. The other is to convert the net present values into what are called equivalent annuities. I mean, that sounds complicated, but let me take the first approach first. Here's what I did. I took project A and I did it twice. What does that mean? I take project A, I do it for 5 years. At the end of the 5 years, I invest back $1 million and get $400,000 for the next 5 years. Now I have 2 projects with exactly the same life, 10-year life. If I do the net present value of project A, replicate it twice, I get 693 million. The net present value of project B, I get 478. I'm comparing apples to apples, I could take project A. Okay? David asked, can I divide project B by half? That's going to be much more. You can't do that, right? Because that's not fair. Because you can't stop a project midway. No, so unfortunately you can't divide. You always have to multiply. You're saying this sounds good. Let me work with it. It works nicely here because I was comparing a 5-year to a 10-year project. What if I gave you a 7-year and a 9-year project? You know what you'd have to do? Replicate project A 9 times to get to 63 and project B 7 times to get to 60. Do you want to do 63 years of cash flows? I don't. So here's the second approach, right? Remember, the problem with the NPVs is they're a lump sum. They give me one value for a 5-year project and one value for a 10-year project. If I were in a hurry, could I take the NPV and divide by 5 and for the first project and the NPV for the second project and divide by 10? Yeah, I could if I were in a hurry. But since I want to stay with time-weighted cash flows, here's what I did. I took the NPV and I said, what annuity would I need over the 5 years to get to the same net present value? So in the case of project A, to get to a net present value of 442 million, I'd need 122.6 million as an annuity. You say, what are you doing? Take out your calculator if you have one. You don't have to do it right now. I'm talking virtually. Enter 442 million as your present value. Enter 5 years as N. Enter 12% as your discount rate and look for the payment. 122.62 million every year for the next 5 years is the equivalent of 442 million today. I've converted the 442 million into 122.62 million as annual present values every year for the next 5 years. I do the same thing for the second project, but this time it's a 10-year project, so I take the 478 million, look for a payment over 10 years, and I get a payment of 84.6 million. This will give me exactly the same answer as the replication, but I can do this for a 7-year or a 9-year project without actually replicating. Implicit in both approaches is the point that Shashanka raises, which is, hey, what if project A is a one-time deal? What if there's nothing after year 5? I said I was assuming I can take project A, but I don't have to. What if you can make a different assumption about a different 5-year project that you think will be available? You can actually take this approach and be much more flexible with it. But essentially the point I'm trying to raise is, comparing net present values in 2 projects when they have different lives doesn't make sense. This plays out in household choices all the time, right? You have a house, you want to replace the roof, and you have 2 choices. You can go with the more expensive roof that lasts for 25 years, or the less expensive roof where you have to do it every 10 years. If you just look at the expenses, the 10-year roof is going to win every single time. I'm not saying you have to do an equivalent annuity on that. But you should probably be doing something to control for the fact that one roof lasts 25 years and the other one lasts only 10 years. That's exactly what we're doing here with the replication in the annuity. So before I kind of wrap this section up, this is something you face all the time. We don't subscribe to magazines very much anymore, but in the old days you used to get these deals from magazines. You subscribe for 1 year, it'll cost you $20. You subscribe for 2 years, it'll cost you $38. Subscribe for 3 years, it'll cost you $54. Basically, they want you to just divide the numbers by 1, 2, and 3, and guess what? The 3-year subscription always looks better. What they're not factoring in is the time value of money. So I'm not saying again with a magazine you want to do this, but try it out. Take the 36 over 2 years and make it an equivalent annuity over 2 years. Use whatever your opportunity cost of capital is. Take the 54 over 3 years and make it an annuity over 3 years. That's what you should be comparing, not just dividing by 2 or 3. And that's effectively what we're doing here. We're making them more comparable by making them into annuities. Any questions about the annuity approach? Okay. So now I'm going to ask you a question, and there's no right answer to the question. We've talked about different decision approaches, right? We started with accounting returns, return on invested capital, return on equity, accounting earnings, accounting book value, returns. We looked at payback and discounted payback, where we looked at when do I get my initial investment back. We looked at net present value, which is a time-weighted incremental cash flow measure of return, but it's in dollar value or in absolute numbers. We looked at internal rate of return, which is a percentage return, which makes a different assumption about reinvestment. and we looked at PI, where we took the net present value and divided by the initial investment. So I'm going to reframe this question because we're in a fresh crisis. Yeah. So first, I'm going to ask you, if you had to pick an approach, and you don't have to tell me, so you can pick it on your own, kind of think through the different pluses and minuses. And this is something you're facing with Netflix Fit as well, right? Because you can use any of these approaches for Netflix Fit. And ultimately, the question I ask you is, will you accept or reject? You're facing this challenge of which approach. Which one would you pick? Okay? So pick whichever one. As I said, you don't have to tell me. Then ask yourself, given the last 6 weeks, forget about the 2008 crisis, we have an even more immediate crisis. Given the last 6 weeks, would you, in other words, if you'd been doing Netflix Fit at the start of February, and then you're doing Netflix Fit now, could your choice have been different? And if so, why? Anybody?
Maybe you would be doing NPV initially, but now that you're more defensive, you want to do payback period.
Okay, so let's that's or payback, or even that's a very good point. So, what are the characteristics of Netflix that you'd have to look at to make a judgment on whether you want to make that shift? Why would you want to go to payback? Because you're worried about getting cash flows in the near future, right? When are you most worried about cash flows in the near future? It's because when you have a lot of debt, you worry about making debt payments. If Netflix were a highly levered company, payback might be what you've shifted. Not because you don't remember your corporate finance lessons, but what do you need to do? You need to make sure you get cash flows quickly. You know what? At United and Boeing, I wouldn't be surprised if right now when they're thinking about decisions, the decisions are being driven by payback. I actually am a United Mileage Plus member, and I use miles all the time. And I'm waiting for that deal of a century where they allow you to buy miles at a discount, because they're going to be selling miles at huge discounts, even though they can do a capital budgeting analysis. It doesn't make sense for them long term, but they need cash now. So one of the things that happens in a crisis, you see people shifting to payback if they're desperate, or to internal rates of return if they're smaller, because now they want to take smaller projects, not bigger ones, because they're worried. So crises can shift payback rules. And it'd be interesting if somebody had followed up on these surveys that used to be done. The last one I found was in 1998, where companies were surveyed as to what decision rules they used to decide on projects. So this actually looks at a comparison between 76, 86, and 98 on which decision rule dominated. So if you take 1976, so this is the primary decision rule. Companies might have 5 or 6, but this was the driver. In 1976, the most commonly used decision rule was internal rate of return, followed by accounting return. NPV was used by less than 10% of companies, payback by about 9%, and PI by about 3%. You move forward 10 years, IRR still remains the dominant rule. Accounting returns have dropped off to 8%. NPV has gone up to 21%, but payback jumped to 19%. You say, what happened in 86? A lot more levered companies. This was the start of the leveraged buyout. Scenarios where you saw companies borrow more, 19% payback. 1998, IRR has drifted down even further. NPV has climbed even more. Accounting returns hang in there, they're stubborn, and payback has dropped off. I'd be interested to see what 2020 looks like in terms of the survey. But I'll be quite honest, I think IRR still dominates NPV in most companies. You know why? Because it's much more intuitive to think of returns in percentage terms than in dollar terms. Now, this is something I might have mentioned earlier. If I asked you, what did your portfolio do last year? Probably that's a painful question you don't want to answer. Nobody says minus 300,000, they say minus 25%. We tend to think of returns in percentage terms. IRR is much more intuitive to companies than NPV. Managers still like to say, I have a good project, it makes 27%. Not, I have a good project, it has a $270 million NPV. So I don't have a problem with people using internal rate of return as long as they're aware of where it's going to get them. It's going to push them towards smaller projects. It makes some serious assumptions about reinvestment that drive it. And as a consequence, IRR wins. And if you say, why didn't they use modified IRR? Because, as I said, if it's a standalone project, it doesn't really matter. If the IRR is greater than the cost of capital, the modified IRR is also going to be greater than the cost of capital. If you're picking between projects, maybe you should use modified IRR. But people want something they can get simply and they don't want to explain. IRR, you have a button on your calculator, IRR. Modified IRR, you got to do yourself. So it might be better, but I assume that people will prefer to stay with the IRR calculation. So I was planning to stop on that page. So I'm going to, because we have about for 6 minutes, I'm going to let you ask any question you want about. Doesn't have to be about what we did today. It can be about the class in general, about the project. And if, I think everybody can gain from asking questions about anything we've done so far. So any questions?
Professor, so I think, I don't know if I missed this part when you just said it. If you do modified IRR,
yeah.
If a project has IRR that's higher than cost of capital,
the modified IRR will also be higher than the cost. It's mathematically going to happen, right? Because all it'll do is move it towards the cost of capital, but it's not going to move it below. Yona's question is, when I say smaller projects, I think smaller in terms of upfront investment, not in terms of project length.
Professor, I have a question.
Go ahead.
So if a percentage return is more intuitive, what are some limitations of profitability index?
There are actually relatively few. I think you could, but the percentage is not a percentage that's an annual. Because when I ask you, what did you make as a return over the last 5 years? You give me a percentage return. I assume you made that every year for 5 years, right? But when you do a profitability index, it's a percentage, but it's like a lump sum percentage of the whole project. So it's not as intuitive in terms of being a number you can read as this is a return I can make every year. Do you see what I'm saying? Is if you go back and look at the PI I computed for in example 2, and I give a 47% PI on project A, it's not as if I make 47% every year. I'm just saying the NPV up front is 47% of my initial investment. So it's not quite an annual return. That's why so few people use it, I think.
Regular IRR.
Yeah.
How can you be investing the intermediate cash flows at the IRR if you don't know the IRR yet?
Of those projects, you're assuming that you have like an infinite stream of. That's why I said it's so dangerous, right? So in a sense, you're assuming that whatever IRR you compute for this project, you have other projects that look just like it, waiting to go in year 1, year 2, year 3, and that's part of the reason you should be careful with IRR. Especially really high internal rates of return, because you're not going to have projects like this one.
Yeah, thank you.
Okay.
Professor, I have a question. So to continue with what you said,
yeah.
If let's say I take a project with the IRR 20%, I'm assuming there are other projects with the IRR 20%. And then if I were to take those projects, I would be assuming there are
you have an infinite stream you're creating with the IRRs. You better have that stream or you're going to run into a brick wall sooner or later.
But that's never going to happen.
Yeah,
right?
that's why you have to be really careful, right? Especially when you have it's not making bad projects into good projects. As I said, if your internal rate of return is higher than your cost of capital, that's going to stay true even if you reinvest back at the cost of capital. All it means is you have delusions of grandeur in your head where you think you're going to make 50% returns because that's what your IRR said. When you count your money at the end of the period, even if every cash flow came in exactly as predicted, you know what you're going to find? You made only 31%. It's not a bad return, but it's never going to be as high as predicted. That's why when people try to sell things, they use the IRR. Because they want you to focus on the IRR and forget all those implicit assumptions. So it's not as if it's going to make you take bad projects. It just means you're going to be disappointed in hindsight in what your actual returns were relative to that IRR.
Professor, so one of the things you said is in times of economic downturn, people switch to payback period. How does that help though?
Well, it's basically they want to get cash flows now. So United is selling me miles at, let's say, 1 cent a dollar instead of the usual 2.5 cents. Why? Even though it's a bad decision for them long term, they're actually, think of it as a negative net present value project, because now I'm going to be able to buy tickets at a fraction of the actual price. They want the cash now because they have debt payments coming due. They have to survive. Its survival becomes front and center in this. That's how it helps them. It allows them to survive the next year. And don't underestimate the survival impulse, right? You have to make it through to be able to even think about projects. So they're actually taking bad projects with short paybacks because they need the cash now. Now, Kritik has a question about how sensitive are these rules, I don't know, sensitive to the assumptions, not to the assumptions, but to the kind of project you have. Every project, how the rules behave will be different. So it's almost project specific. Any other questions?
Professor, I had a question about equivalent annuities.
Yeah.
Is part of that explained also by the fact that the 5-year project just has a higher IRR?
Yeah, the two should. I mean, remember, there is an interrelationship. The higher IRR probably shows up in a higher equivalent annuity. Project A is actually better than Project B. So the IRR is not affected by life. So one of the reasons the IRR you can use in comparing a 5 to a 10-year project is the IRR is insensitive to the life of the project. Your IRR is not going to be higher because you have a longer term project. So in that sense, IRR, because it's less biased, if you have projects with different lives, might again be a better decision rule than NPV if you don't want to do replication or equivalent annuities.
Professor, if the IRR is less than the cost of capital, then would modified
Yes.
IRR also be less?
Yep, mathematically it'll always be somewhere between the IRR and the cost of capital. So if it's higher, it'll stay higher. If it's lower, it'll stay lower. Okay, folks, I think we've reached the end of today's session. As I promised, I will email you out the details for the quiz. Don't freak out. It's not the end of the world. And I will see you on Wednesday with the case discussion. So I'll send you those slides actually by just before the class. So check your email about 30 minutes before class begins, because you should get a presentation, or 10 minutes before class begins. That's why I'd like to get your cases. And if you can, send me that Excel spreadsheet with the summary findings. That'd be great as well. Take care, and I'll see you soon.